The world's most tangible assets, buildings, loans, government debt, are quietly moving onto the blockchain. This is not a niche experiment. Projections show this market will swell to $16 trillion by 2030. And it's already started. Giants like BlackRock are not just watching. They're actively launching on-chain funds. This technology is set to fundamentally change how we own, trade, and finance nearly everything. We'll break down how this works for real estate, treasuries, and private credit, and reveal what most people get wrong. Let's start with a massive, illiquid asset class: real estate. Traditionally, prime property was for the wealthy. Tokenization shatters that barrier. It digitally divides a skyscraper into thousands of affordable pieces for small investors. It also attacks bloated transaction costs. A shared digital ledger reduces the need for multiple brokers and agents. Suddenly, a property in Tokyo can be owned by someone in Brazil. Geographical barriers dissolve, widening the buyer pool. So illiquid property becomes more accessible and efficient. But what happens when you apply this to the safest asset? This brings us to US Treasuries. They're already highly liquid. Why are firms racing to put them on chain? The why is a system upgrade. Traditional bond settlement takes days. Tokenized treasuries can settle almost instantly, 24/7. For institutions in digital finance, this is huge. It gives them a stable, yield-bearing asset native to the blockchain. We've seen it for real estate and treasuries. Now let's look at a market that operates in the shadows: private credit. Private credit means complex loans that are hard to sell. Tokenization turns a large loan into smaller, tradable units. This opens a new funding source. Small businesses can now tap into a global pool of digital asset investors for capital. The process is automated. Loan terms and payments are coded into the token, reducing overhead and adding transparency. This is not theory. BlackRock's Whittle Fund is a live example, a tokenized treasury product managing hundreds of millions. Across 3 different assets, we see the same pattern: access, efficiency, new markets. But the fine print matters. The biggest hype is liquidity. But this is a dangerous misconception. Tokenizing an asset does not magically create buyers. Liquidity depends on market demand and regulation. Tokenization is a tool to enable liquidity, not a guarantee of it. And here is the most critical point many miss. When you buy a token for a building, you rarely own the physical bricks. You typically own a share in a legal entity, like an LLC, that holds the asset's title. The token is a claim on that entity. This creates a paradox. We use decentralized tech, but the assets depend on centralized legal managers in the real world. This brings us back to treasuries. They're tokenized to become a foundational, trustworthy building block inside this new digital system. Now connect the dots. Take those on-chain BlackRock treasuries and use them as pristine collateral to back on-chain private credit loans. Or take a fraction of that tokenized skyscraper and use it as collateral for a loan, unlocking its value without a sale. This is the true goal. Not just isolated tokens, but interoperability. Assets become programmable building blocks for a new system. So, what have we established? Tokenization isn't about replacing assets. It's a digital wrapper to improve them. This shift is happening now, driven by the biggest names in finance. We are in the early days of a $16 trillion restructuring. But success requires knowing the details. The difference between hype and reality, like the truths of liquidity and ownership, is key. This is a move towards a more transparent and secure system. Every transaction is recorded on an immutable ledger for all to see. This is not simply a new product. It is a new market structure being built piece by piece right now. The question is no longer if assets will move on-chain, But how fast? This is a trend no serious investor can afford to ignore. The digitization of everything is here. Welcome to the future of value.